Good morning, everyone, and welcome to our next fireside chat. Joining me today is Alan Brett, who's the CFO of Descartes. And just to reintroduce myself, I will be the moderator for this fireside chat. My name is Nick Agostino, and I'm the Diversified Technology Analyst here at Laurentian Bank Securities. Before we get started, just a couple of quick housekeeping items. Just please ensure for all the attendees that your microphone is on mute and your camera is turned off during the session. Please ensure your name appears on screen so we can properly address any questions you may have. And when it comes to questions, feel free to use the hand feature or submit a question by way of the chat, and we'll get to that question as soon as possible. And so everyone knows, questions will be moderated today by Jordan Simon, who's also on this call, and he'll be handling any technical issues should they arise. So that said, we'll get started. So Alan, welcome.
Yeah, hey, thanks for having me, Nick. Appreciate it.
So just getting into the meat and potatoes. My first question, and I think it's a very interesting and timely one. In January of 2022, so January of this year, we saw an announcement out of Microsoft and FedEx where they've said that they were going to develop what they call a joint logistics as a service platform aimed at increasing the merchant competitiveness in the e-commerce space by trying to get more customer engagement and offering more shipping options. So I'm just wondering, with this alliance in place, how do you see it transforming the commerce space from both a supply chain and logistics perspective? And then do you see this alliance as posing a threat to Descartes or possibly an opportunity for Descartes? And is there any initiatives that you guys are undertaking of a similar nature?
Yeah, no, hey, very good question. And maybe I'll take it more on a broader than just the Microsoft FedEx piece. But often when we see things like this, a couple of years ago we saw Maersk announce something with IBM. And I think the way I want to leave an investor with is when you hear these types of announcements and you think of the logistics space, if Microsoft and FedEx are doing something together, that's in this case, it's FedEx having a module that sits behind Microsoft Dynamics. You should think of that as whatever comes out of that solution is going to be awesome for FedEx, right? They're not looking to make it easier for a customer to find freight rates in various carriers. This is a carrier-specific solution that FedEx is trying to enact with Microsoft. And you can bet that's going to be a great solution if you want to entirely ship all your parcels with FedEx. Descartes' network that we've built out and our solutions have always maintained one thing, which is we want to be neutral. We're not owned by any carrier, any broker. So anything that we're doing would be focused on finding you the best parcel solution across any parcel solution shipper, or possibly less than truckload, finding you the best way to ship your goods, not just being agnostic to a FedEx or a UPS or USPS or a Purolator. So from our perspective, when we see those types of announcements, it's interesting for us. It's not a big competitive threat because I think the customers who see this would say, a very small select customer set would say, hey, I want to be with FedEx exclusively. Most customers, when they're educated, would say, I want to ship with whoever the best partner is at that particular moment on that particular day. And that's what Descartes does from a network connection perspective and its software solutions. We will maintain our independence, our neutrality, and want to benefit the customer across any carrier. So when you see those types of announcements, obviously great to ask the question, obviously great to explore, is it good, is it bad? Longer term, we think those are just more ammunition for people to say, I want to be with an independent carrier or an independent solution, technology solution.
So if anything, they draw awareness, and that in itself draws opportunity for you.
Exactly. It is a theme that technology solutions coming to the logistics space are important, like making it easier to press buttons and connect and get your freight bookings is a theme there. We would just argue it's better to do that on an independent, neutral basis, not with one carrier.
No, fair comment. So my next question is one that we've asked both Texas and Canaxus earlier today, and one that I'm equally interested in your response. So obviously, over the last 2 years with the pandemic, I'm curious to hear what you have learned about your customers and the market that you're operating in that maybe you did not anticipate pre-pandemic. And then at the same time, what do you think your customers and the prospects that you guys are harvesting, what do you think that they have realized as a result of the pandemic that maybe has drawn them more towards your solution again, as a result of the pandemic?
Yeah, I think another good question. I think that early on in the pandemic, if we think about what happened in the freight market, we've never seen this before, but we saw basically, almost a complete shutdown to, the way most companies operated. Offices were shut, retail stores were shut, and I'm talking about North America, but you can extend it. It pretty much happened around the world, and this was something that people hadn't seen before. And so, while people were getting ready and good companies have adapted into a sort of an e-commerce model, people had to very quickly react. How can we do business in a model where we're working from home, or our customers have to go to the curbside to pick up goods, or we have to find a way to deliver those goods to them in a more robust way? So we saw lots of activity around e-commerce and the trends of e-commerce just accelerating. Again, already there pre-pandemic, but even more exaggerated because the pandemic forced it. And I think coming out of that, that was probably, let's call that 2020. 2021 would be more a year where it was a bit more balanced between, well, this is a trend that's not going away, but I've got to be able to operate in both worlds of, that omni-channel. My store is going to be open. I'm still going to see traffic and trends in e-commerce. How do I adapt to that? And I might extend it. So that's what I think our customers have seen. From our perspective, what we've seen is that kind of change that comes, any change that comes to to the freight world, our technology usually is a good solution to help people solve that pain point, right? That is what we're in the business of doing, are using our technology solutions, our data, our network, our software to help people when they go through these types of moments of stress. And if anything, it showed us that our solutions are valuable. Sorry, as I get rid of a call, are valuable, that they add value in solving these pain points for the various customers. And I think that extends into things like we've seen recently with the conflict in Ukraine, where sanction lists get changed. We have to change our supply chains. We have to change something because of Russia. There's now tariffs in China. These are additional types of changes that are ricocheting out of some sort of big event. So hopefully I answered it. I think we saw the importance of e-commerce type solutions, and then now more into that balance of, there's going to continue to be changes in my supply chain. How do I find and use technology to make that change better? Yeah,
and much like others have said, it sounds like the pandemic was certainly a catalyst. As unfortunate it might be as far as living through a pandemic, but it is a catalyst and draws awareness to your business.
Yeah, absolutely. If you take that broader theme of it was a change that people were not prepared for. Right. And then when they get into that type of change and it's affecting their supply chain, it's affecting the way they get product to customer, then that's when people throw their hands up and say, hey, let me look at these technology solutions out there. And that's exactly what happened.
So my next question, I think is somewhat interesting for me. I remember when you and I first met a few years back when I was looking to initiate the coverage. I remember asking you, how high do you think you could take the EBITDA margins? And at the time you had indicated 40% was where you thought we could see some resistance, just from a pure market perspective. And so with the pandemic, obviously you guys did some cost containment and you were able to expand your margins beyond the 40% threshold. So kudos to you, specifically, obviously, as a CFO on that front. And I think we're seeing the 42% level right now. And I think you guys have done a little bit of real estate consolidation to help the margins either now or going forward. And the question is, I know that Ed and you guys have not put out a number just yet in terms of maybe what is the sustainable number, but can you share, your comfort level around where you think you can get the EBITDA margins to, and maybe what other levers you might have in your pocket to help you guys maybe squeeze out a little bit more on the EBITDA margin front?
Yeah, so let me try to take a few parts to that. So I guess I'm glad I was wrong. Let's start with that. If I did say that of 40%. I think from our perspective, EBITDA margins. So, we're a collection of a number of different products. Some of our margins in the products are well north of that 40% margin level. When we grow organically, our margins, our incremental margins are quite strong, right? Our databases, our software, our network have been built out. And so additional users, additional volumes in these products are very, very helpful from an EBITDA margin perspective. So that's one thing to keep in mind. I think from a pandemic perspective, and what will happen with those margins is that with good organic growth, we'll still see improvements. We are investing heavily in our business, but we should still continue to see improvements in margins over time with organic growth. With the pandemic, and one of the reasons why we haven't updated those operating margins quite yet is that we're not sure we're operating in a normal environment. It's not a big impact on our cost structure, but we're not traveling as much. We're adapting our marketing plans, etc. And as we come out of the pandemic and we get into more of a stable open office environment, I think we will be much clearer and be able to sort of give some guidance there. We don't think it's a huge impact on our margins, but it's still something we don't know yet completely. So, last quarter we were at 44%. You're right, we were at 42-ish for the year last year. We're going to wait and see how that plays out. I think the bigger thing, the longer term trend, is with continued growth, there's still strength and opportunities in our operating margins while we still invest in the business, which we've been doing quite readily as well.
Okay. So again, we'll as you said, we'll stay tuned. It sounds like we're possibly a couple, maybe a few quarters away from when you guys have a better, hopefully, a sense of normalization in the business and in the environment. Next question is just with regards to multiples in the industry. So as we all know, since about maybe September of last year, we've seen multiple compression in the tech space. And I'm just wondering, does this, as you guys are very acquisitive, just wondering, does that multiple compression, what is it opening up maybe opportunities on the private market side now that we're starting to see multiples come down on the private market side, that maybe starts to either accelerate your rate of M&A or maybe make some opportunities that in the past you thought were too expensive, now they're coming more and more into your wheelhouse? And does that maybe open up the prospects of larger acquisitions as a result? Just maybe any thoughts you have on the whole capital allocation as a result of that multiple compression?
Yeah, for sure. So I think a couple things to think about there is, for the most part, as rates came down over the last number of years, we didn't change our economic fundamentals on acquisitions. The way we look at an acquisition is, we're going to deploy capital. We want to get our money back in 5 to 7 years. We would like to get a 15 to 20% return on that invested capital. While people kept saying to us, hey, why wouldn't you bend your rules, break your rules, adjust that threshold? Rates have come down. You can be accretive to your numbers if you paid, with a 10% return on invested capital. We resisted that narrative, and I think stuck to this is what we think is right longer term. And we've had to fight a little bit harder to find those types of acquisitions that make those paybacks. We are blessed with the fact that we're in a very fragmented, immature market, if you will, with lots of different companies that are doing something in logistics, solving a pain point with their technology. So that's helped us. As rates come up here, a couple things. One, it won't impact us as much because we didn't adjust our numbers. Two, it'll take time for the private companies. I think we've seen a market valuation change in the public side. I think it takes time on those private companies to say, hey, what I want is yesterday's price and not what is a fair price in the type of environment we're in today. So simply put, while they might have argued a lower than 10% return on capital to the buyer was fair in that 1.5% interest rate environment, now they might come to grips with a little bit more that is in line with our thinking. We do think that happens over time. We're probably starting to see some signs of it. There'll be more signs of it to come. From a size perspective, the bigger deals have had a lot of private equity looking at them, a lot of people chasing, this is a hot area, right? Logistics, supply chain, tech solutions growth is good. And so we'll see that sort of evolve, I think, over time. I think longer term, it will be helpful to the acquisition environment to have more realistic expectations. I think I'd layer on, should we get into the R word, the recession word, who knows? But, recessionary environment will be bad for freight volumes. It'll hurt our organic growth slightly, but it would also probably be an interesting opportunity for capital deployment opportunities as well. So we're going to watch and see whether they're small deals or large deals. We still think we're incredibly fragmented in the space, and that's a long-term, multi-year issue for us. And so, we do see it will take some time, Nick, but I think it comes back. The private market side comes back over time, and perhaps it's a little bit easier to deploy capital for us in months ahead.
So always remaining true to your disciplined approach, which I think is very wise. Sticking to the whole M&A theme with a little bit of a twist here, when we look at the acquisitions and broadly speaking, we look at the acquisitions you've made over the last few quarters, they seem to cater around border compliance and trade flow and e-commerce market segments. And the question is are these the market segments where you think you're going to be the most active going forward? Is it coincident? Like, are you guys focusing there, and hence that's why those transactions are happening? Is it because the demand is there and you're focusing there as a result, or are you just going to go where the opportunities present themselves, or are you going to stay more focused on those two specific segments?
Yeah, I think it's more a coincidence, and I'll explain why. So the way we look at them, and it goes back to my comment, it's still a very fragmented, technology market for us in logistics. There's still tons and tons of holes in our product offerings, what we could supplement and do better with. We're looking at literally hundreds of companies and keeping them on our radar screen, and it's not a market today that we feel that we have to follow a certain set structure of consolidate this piece of it or that piece of it to be stronger. A lot of what we're doing is buying, our next door neighbor's house in the market we're in, and we're adding and supplementing, bolting that onto our technology solutions, making those things work together, whether those are in customs compliance or in the broker forwarder space, or whether they're in content or transportation management. There's going to be, or network, there's going to be a number of different opportunities. And we don't think it's a market where we have to rush and say, we are weak in this one area, we're suffering. It's really a market of, whether those are solution-based, whether they're geographic-based. We're not in the North Americans consolidated in Europe, it's not. It really simply is still long-term consolidation opportunities, and pick the ones that make the right, hit the right metrics from a payback perspective, where the people are ready to sell. And I would say to you, there's tons of companies we're looking at where we would love to have them, not all at once, but we'd love to have them. They're just not ready yet, whether the ownership's not ready, whether their expectations aren't realistic. So we have the luxury of that immature market that buys us the time to say, there's no one area that we're focused on. It's just going to be continue to make us stronger as a network, as a base of customer and base of technology solutions that we can offer.
So as you said, by coincidence, not by design.
In this case, yeah, I'd like to, I guess you'd say, hey, there's a grand plan or a set plan that's different. Right. The playbook is simply continue to add strength across this entire market in logistics technology.
Right. Okay. And so another question that we've asked Texas and Kinaxis earlier today, one that just reflects the current environment we're in. the geopolitical situation in Russia and Ukraine, quite possibly China and Taiwan down the road, and hopefully not, but nevertheless, there is more and more chatter around onshore production. So moving away from a globalization mentality that we saw probably since the late 80s to more the onshore. And I'm just wondering, how do you guys see that as changing the flow of goods? And more importantly, do you guys view that as a positive catalyst for your business? Is it going to be neutral to your business, or quite possibly negative if we get more of an onshore type mindset?
Yeah, for sure. I'm going to come back to that earlier comment I made, where complexity and change in supply chain and logistics is good for our business. It puts stresses on the players involved, the shippers, the carriers, the brokers in the middle. And this is one example. Now, how much you are willing to believe that onshoring will happen? What is going on is, I'm producing in China, I'm single threaded. Well, I better look at other places. Maybe I want to produce elsewhere in Asia, in Vietnam or somewhere else. Or I want to bring part of my production onshore. I might bring all of my production onshore. All of these change the dynamic, right? They make our international tariff databases maybe a little less strong. However, instead of buying finished goods, you still may be buying some components from somewhere else. You've now changed something in your supply chain. Domestic trucking could be stronger. Some of our cross-border stuff might be hurt. We don't necessarily care where goods are moving and flowing from. They could be from China to the US. They could be from Vietnam to the US. They could be, a number of different combinations. The bigger theme is that's creating a change. Someone in the back office at some company is saying, we're now changing. And that disrupts how I was handling things before. I better look at a technology solution or explore some technology solutions that might help me. So from that perspective, it's good for us. Do we care? Do we get super concerned when we're extremely fragmented in the offerings we have? If our largest solution is less than 7% of our business, even if it was helpful to one of our solutions or not, these won't be massive changes in disruptions to our revenue flow. But general theme, change is good for us. And this is just one example of it.
You brought up a line right there that I was gonna use to conclude, and you said it. Change is good. That's the key takeaway here. Just to make sure we do, just given there's lots of chatter around ESG in the marketplace. I think recently one of your customers, I'm not sure if they go by the name of SIG or SIG, they talked about they adopted your solution set specifically to allow them to meet their, I guess, ESG objectives. So it sounds like there's more and more interest on that front when it comes to using Descartes for ESG objectives. And I'm just wondering, what investments are you making on the ESG front, and are you seeing the ESG in general as a catalyst for adoption amongst your customers, similar to SIG?
Sure. So maybe I'll try to touch on the ESG topic on two layers. One is that shareholder layer that we get a lot from the audience that would be on this call, of what are we doing to improve our scorecard, our disclosures, et cetera, when it comes to those three elements. And then maybe address after that the customer side of it. So from a regulatory perspective, from a compliance governance perspective, we are certainly watching what's going on out there. We take it very, very seriously. Obviously, we're in business to make money, but to do so in the proper way. So we'll be improving our disclosures around in this coming annual cycle of our annual filings that are coming out. Our disclosure will have something in there in the area of a sustainability report that will talk about how we look at ESG from a business perspective. Certainly from a governance perspective, we've been front foot there with a diverse board. We're expanding the diversity of it. We're continuing to think of those things across our entire population of staff. Environmentally, how we reduce our office footprint, how we reduce our drag or negative to the environment as we operate our business. So those are all things we'll be doing and announcing and putting better disclosure out there. I think we line up fairly well when people sort of digest everything we're doing, including cybersecurity, which is a big area that we're investing in. When it comes to our customers, it's interesting because what we do is incredibly good for the environment, right? We take trucks off the road. We reduce miles driven. We reduce paper flow. We make things more efficient to take less time. What we've been told is those things don't give us any benefit on the scorecards from an investor perspective. And we think that to that we say, okay, no problem, because we know that they're real, tangible things that benefit our customers. Our customers can implement our solutions and get marks and improvements in their scorecards for ESG. So that fits for us. That's not a problem. And we are marketing as such, right? We know that our solutions can be very, very beneficial and to people's scorecards. And certainly we're aware of that, and that's factoring into our discussions. It will not be a negative to our business. People look at ESG and think, if I could do better, if that's the reason why they want to save miles and implement a Descartes solution, we'll still be selling on an economic payback, but be very aware that this is a positive and certainly a significant positive to a lot of customers when they look at their own ESG footprint. So hopefully that answers both questions. We're aware of it on the customer side, and we are definitely factoring that into our plans around a number of our products. We're aware that we get no credit for that from a scorecard perspective to an investor. To that we say, we're still going to talk about it. We're still going to make that as part of our documents, and yet we'll still do everything else we can that does give a scorecard credit to in these various regulatory bodies that are monitoring this stuff, to make sure that the world and the investing public sees that we are extremely positive from an ESG perspective. Hopefully
Excellent. Yeah, no, that was a great answer, great insight. Unfortunately, it does bring our presentation or our discussion today to an end, just because we've reached the end of the time period. So, Alan, I do want to thank you for the ongoing support and attending today and representing Descartes. And I want to thank all the attendees also for listening in. Hopefully, you found it equally as insightful. And I'll just remind everybody that our next presentation will be magnet forensic, and that'll start at 12:20. So thank you everyone. Bye-bye.
Thanks, Nick. Appreciate it.